Hi friends, after dropping to a 52-week low of Rs 1363 on Feb 14th, HDFC Bank has climbed by more than 8% in the last month, showing a strong upward trend. In the past week alone, the stock saw a surge of over 6%, indicating high buying interest. Many brokerage firms have now increased their price target for the stock, some by as much as 38% above its current price, and they recommend buying it. So what's behind this change? After falling more than 15% this year, is the stock starting to recover? How high do experts think it can go? We'll explore all the answers to these questions in this video. Before we explore the reasons behind HDFC Bank's rebound, let's quickly recap why its stock was declining in recent months. Following the merger with its parent company HDFC Limited, there was concern among investors and analysts about the time needed for these two large entities to fully integrate and consolidate. One particular worry was the loan to deposit or LDR ratio of the merged entity. Before the merger, HDFC Bank maintained a healthy loan to deposit ratio of 80 to 85%. However, this ratio surged to 110% following the merger, sparking concerns among investors and analysts and contributing to a significant drop in the stock price over the past 10 months. A high LDR ratio may compel the bank to borrow or incur debt to fund its lending activities instead of relying on its deposits. This can potentially diminish its profitability. Considering the fact that RBI's recommended LDR ratio is 75%, HDFC Bank has recently been working to reduce this ratio to a more manageable 85 to 90%. Investors were worried about a possible decrease in the bank's net interest margin or NIM. NIM is the difference between the interest earned by the bank through loan advances and what it pays to its depositors. The bank's push to boost deposits over loan issuance raised concerns about a potential dip in NIM. Furthermore, attracting more deposits might require the bank to offer higher interest rates to its customers, again affecting margins and reducing profitability. Third, the liquidity coverage ratio or LCR of the merged entity was at 110%, below the preferred level. The LCR measures a bank's ability to cover short-term obligations with its high-quality liquid assets during a 30-day stress scenario, essential for surviving financial strains. In simple words, LCR tells us if the bank has enough cash to survive a 30-day financial crisis. The higher the LCR, the better it is for the bank. A lower LCR of 110% prompted concerns about the timeline for the complete integration of the two firms. Now let us see why the stock soared during the last week. The rally in HDFC stock was attributed to the business update released by the bank on April 4, detailing its Q4 fiscal year 2024 performance. In this quarter, the bank's deposits reached Rs 23.8 lakh crore, marking a significant 7.5% increase from the previous quarter by approximately 1.6 lakh crores. Retail deposits saw a 6.9% rise quarter over quarter, adding up to a 1.28 lakh crore or 1.28 trillion increase. Wholesale deposits also experienced a healthy growth of 10.9% quarter over quarter. On the other hand, loan advances as of March 31, 2024 amounted to 25.08 lakh crore, only a modest 1.6% increase from the 24.69 lakh crore observed at the end of Q3 on December 31, 2023. While the domestic retail loans grew by 3.7% quarter over quarter, commercial and rural banking loans increased by 4.2%. In contrast, corporate and other wholesale loans saw a decrease of 2.2% quarter over quarter. The bank also posted year-over-year growth figures, but we will not go through them here as they do not reflect true growth of the bank. This is because this year's figures include advances and deposits from the erstwhile HDFC Limited. This makes the year-over-year growth figures for Q4 of fiscal year 2024 as compared with Q4 of fiscal year 2023 to appear inflated. A notable highlight was the growth in Kasa or current account savings account deposits in Q4. This rose by 8.7% year over year and 8.8% quarter over quarter. Retail Kasa grew approximately 8.8% year over year and 6.3% quarter over quarter. However, the bank's Kasa ratio, indicating the share of deposits in the current and savings accounts relative to total deposits, declined to about 38.2% as of March 31st, 2024 from 44.4% as of March 31st, 2023. It did show an increase from 37.7% as of Q3 ending December 31st, 2023. The decrease in the year-over-year Kasa ratio over the last quarter is likely due to inclusion of deposits from the HDFC Limited post-merger and hence not worrisome. The 44.4% Kasa ratio from the previous fiscal year was exclusive to HDFC Bank before the merger. A higher Kasa ratio is advantageous for the bank as these accounts typically incur little to no interest, making the funds cost-effective. Thus, the bank can achieve greater profitability and better margins by leveraging these low-cost funds. The market responded favorably to the recent business update. Although the earnings report for the last quarter of fiscal year 2024 is scheduled for release on 20th of this month, the preliminary update has already boosted investor and analyst confidence, suggesting the firm is successfully managing its consolidation efforts. Analysts had anticipated deposit growth to be in the range of 1.2 to 1.3 lakh crores, but the quarter-over-quarter growth for Q4 exceeded expectations, reaching 1.66 lakh crores or 7.5%. This represents a significant increase compared to the previous quarter's deposit growth rate of just 1.9%. Retail deposits in particular saw a 6.9% increase or 1.28 lakh crores quarter over quarter, a notable rise from the 2.9% growth observed in Q3. On the other hand, loan advances in Q4 grew by only 1.6% quarter over quarter or 0.3 lakh crores, a marked reduction from 4.9% or 1.1 lakh crores growth recorded in Q3. The moderation in loan growth combined with the unexpectedly strong performance in deposit accumulation contributed to lowering the loan-to-deposit ratio from 110% to 104%. This development was seen in a positive light by the analysts. Post-business update, a number of brokerage firms revised their target price on HDFC Bank. This helped stock post big gains last week. Motilal Oswal Securities suggested a target price of Rs 1950 on the stock. Motilal Oswal said, despite the moderate growth in advances, the anticipated rise in banks' deposit has gained momentum with a quarterly growth of 7.5% supported by a healthy increase in the Kasa deposits by 8.8% quarter over quarter. The bank initially experienced a higher LDR ratio following a merger. However, with the progress made in the deposits mobilization in Q4, the LDR ratio moderated 6% quarter over quarter to 104%. Morgan Stanley has kept its overweight rating on the stock, setting a target price of 1,900. The brokerage also emphasized that the surge in deposits was an unexpectedly positive development. Financial services from Macquarie continues to recommend a buy rating for the stock with a target price of Rs 2,000. According to Macquarie, the recent business update demonstrates that the bank's consolidation strategy is working well. The firm highlighted the robust deposit growth and reduction in corporate loan growth and LDR as particularly favorable outcomes. The report by Macquarie released said, for a large bank like HDFC Bank to deliver 7.5% quarter-over-quarter deposit growth, Rs 1.7 trillion deposit mobilization in a single quarter, and even improve Kasa growth. Kasa growth was higher than overall deposit growth, all a fantastic outcome. HDFC Bank valuations remain attractive and it may be an opportune time to add the stock, Macquarie said. Incred Equities has also observed the improved LDR ratio for the bank. Despite a significant increase in deposit growth, the firm anticipates that the net interest margin or NIM for the bank will stay within the expected 3.7% as the bank is adjusting the pricing of its retail assets accordingly. Incred said, we remain confident over asset quality profile of the bank and expect operating leverage may surprise positively during the quarter. They set a target price of Rs 2,000 for the stock. Citi has kept a buy recommendation on HDFC Bank, setting a target price of Rs 2,050, the highest among its peers. This revised target suggests a potential increase of 38%. Brokerage Jefferies has also continued its buy rating on the stock with a target price of Rs 1,800. On the other hand, financial services group Nomura holds a neutral stance on HDFC. Its target price is Rs 1,625 per share, citing slower than loan growth compared to the overall banking sector's year-on-year loan growth of 16%. Nomura has also expressed concerns that the liquidity increase from strong deposit collection could pressure the net interest margin. To summarize, according to Bloomberg data, 45 out of 50 analysts tracking the company have a buy rating on the stock, while 5 suggest a hold. The average target price from analysts over the next 12 months indicates a potential 23.1% upside for HDFC Bank. As noted by an expert, despite earnings growing at a 17% CAGR over the last 5 years, HDFC Bank's market capitalization has only increased by 9%. This suggests there is a significant room for long-term growth of this banking giant. That wraps up our update for today. Looking forward to our next video. Have a great day.